Well, hello there, boys and girls of YouTube world. It is Sunday, November the 28th, and hopefully this finds you doing fantastic. And feel free to subscribe, click the like button up, comment, and share. Maybe I'll stop saying all that stuff. I don't know. But remember, mazske is not a CPA, especially in this. I am not a CPA. I'm not a financial advisor. I'm not an attorney. But what I'm going to talk on today is taxes. Everyone's favorite subject, taxes. Yeah, woohoo, taxes. Yeah. All right, I'm gonna tell a quick story. Back in 2014, I sold Netflix stock. It was in my normal brokerage account. I had a gain of, I don't know, 1,500%, let's just say. So I was not making a lot of money. So that chunk of money I got was all taxable. So I had to pay capital gains tax on it. It hurt. It was, I don't remember what it was, $4,000, $5,000 that was owed. It was a lot of money. It hurt. Okay. Every year with my taxes, I would try to tweak not my W-2, whatever you call that withholding thing. Because I wanted my tax refund to be zero. I didn't want to pay a lot. I didn't want to owe anything. When I was in my working career. As close as I could. Sometimes I would owe $100. Sometimes I may get $100 back. That's just how I did it. Okay. Then that was kind of like an anomaly when I sold that Netflix stock, because I had never sold stock with that kind of gain in a normal brokerage account. I've had those gains in my Roth IRA, and that's not taxable. So until it's never taxable in your Roth IRA. And remember, I'm not a tax expert, but if you have Netflix stock in because I had Netflix stock. And if I had held that till now in my Roth until I was 59 and a half, and say it grew from that small amount to a couple $100,000, then I could withdraw it all tax free. Okay. So that's the beauty of a Roth. Now with stocks, if you have them in a normal brokerage account, anytime you sell them for a gain, it's capital gains. I'm not going to get into capital gains tax rate because it can change from year to year, administration to administration, it can change. Okay, and we're all different with our income, et cetera, it's all different. So anyway, real quick then, if you are an investor in stocks, you will pay taxes from time to time when you sell something, if it's in your brokerage account. If you are a real estate investor or an alternative type investor, there are ways to minimize your taxes. I'm going to start with real estate. You heard me in yesterday's video talk about my rent income for the year. Okay, it was something like $177,000. All of that rent is not taxable. Not at all. Not at all. I don't know exactly what my final taxable figure will be on that rent, but my guess is it'll be a couple $1,000, maybe. I don't know. We'll see when my taxes are done. But what you can depreciate, first of all, you can depreciate taxes and insurance. You pay taxes, you pay insurance. It's a write-off. Any expense you have, any repair you make, you change a hot water heater, parts, labor, you put a roof on, you fix a leaking sink, you route out a sewer line, any expense you have, it's a write-off. It's a tax write-off. Okay. You also get what's called depreciation on rental property. They take the value of there's a formula, and I don't know the formula. I think it's roughly 75-25, I think, roughly, just guessing. But they take whatever you bought your rental property for, you figure out the value of the building, not the land. You take the land out, just the value of the building. So just say you bought it for $100,000, the value of the building is $75,000. So that depreciation is that amount written off over 27 and a half years. So my rental properties, a lot of them are lower priced ones. Some of them are more expensive, but the depreciation might be several $1,000s. Okay. So say it was $2,000 or $3,000. My rental income on any given property, let's just say it was $10,000 for one rental. If I'm writing off taxes, I'm writing off insurance, I'm writing off that depreciation, say it was $2,500. It leaves me with a lot less taxable income. And you do that for every single property you have. It's depreciated like that. But then you get the write-offs. You also get additional write-offs if When I was in Virginia driving to my rentals, I kept track of my mileage. It was a write-off. It was whatever the federal rate was for mileage, like 58 cents a mile or something like that back when I did. So I might drive 1,000 miles during the course of a year, multiply it by 58 cents. That was a couple $100 of a write-off. Okay. If I traveled to Birmingham, I believe, don't hold me to this, I'm not a CPA, I wrote off my price of my rental car, my gas, my lodging, my meals. Because I would just go down and back. It would be a quick trip. I'd write that off. If I flew to Indiana just for the purpose of visiting my rental property, it would be a write-off. The travel to get there, meals, I think, lodging is all a write-off. So you got to keep all receipts. Now, let's say I tie a vacation into it. Say I fly into Chicago and I spend 3 days in Chicago and 3 days in Indiana with my rentals. The 3 days I spent in Chicago, I think, are not a write-off because that's a vacation. But the expense of getting to Indiana, which means flying into Chicago, getting over to Indiana, and making the return trip and staying in Indiana, that's all a write-off, okay? So then also, if you have an office, because if you have rental property, at a minimum, you probably have some kind of computer, and you need to have an office. From my understanding, I'm not a CPA, from my understanding, it could be an office just like I'm in an office right now, okay? I understand this to be, I don't make any income off my YouTube channel. I work on my real estate stuff in here. That's all I do in here, my real estate stuff and a little bit on my YouTube. I don't make any income on YouTube. It's like a hobby for me that doesn't pay anything. So I believe, don't hold me to this entire office is a write-off. The value of this office compared to the value of my house, however that formula is, I think it's a write-off. If I have to buy paper for my printer to print out stuff for my rental property, it's a write-off. If I got to buy pencils, pens, ink, whatever, it's a write-off. My cell phone, I don't think as of yet I will, it's a write-off, but if my business grew even further, any expense associated with my rental business is a potential write-off, okay? You see where I'm heading at? All right, so the point of that is, if you get real estate, if you make $100,000 working a W-2 job, you're paying federal tax, state tax, depending on the state you live in. You're paying FICA tax, Social Security, Medicare, Medicaid, whatever that is. You're paying all that tax. If you make $100,000 from your rental property, the tax you're getting, the taxable amount you're paying tax on is much less than that W-2 worker. Your tax liability is way down compared to that W-2 worker. On top of that, I invest in both oil drilling and mineral rights. And I'll try to be quick here because I know a lot of you don't invest in this. Last year in December, I put $25,000 into the oil drilling company. So that was in tax year 2020. So my tax return this year, I got what was called a K1 in. And out of that $25,000 investment, $20,501 was a write-off. That came off, that $20,501, I believe, came off my adjusted gross income. It was $20,501 subtracted from my income. Okay, that was a tax savings, a big tax savings. That's $20,000 is not getting taxed. Another thing that was done, let me back up to real estate. I have a triplex that I'm selling. I'm supposed to close on it late this month in this year, 2021. Hopefully it doesn't get delayed. And I had done a renovation of that building, I don't know, 2 years ago or something, whatever it was. But we did a cost segregation of my triplex because my triplex was my most valuable property. We did a cost segregation and it was a computer program. My CPA had access to it. I don't know exactly how it worked, but if I remember right, on my tax return, it was I could be wrong on this, but it was a write-off of something like $33,000. It was like all the depreciation. I had bought appliances, I had done the floor, I had done so much stuff. And it was like taking all that depreciation and doing it like right now, I think, something like that. So I was expecting my taxes for last year, I was expecting to have to pay $10,000, $12,000, $14,000. I got a refund back on my federal taxes of like $900 some. That was applied towards my taxes for this year because it was unknown exactly how this year would play out for me. So they just put it towards it. I got something back from one. I have 3 state tax returns. I got something back from one state. The other two states, I owe like $185 and $385, something like that. That's green tea, my morning cup of green tea. Okay, so that's the rental property like that. The oil drilling in 2021 for this year, I have invested another 6 figures into the oil drilling. So when I do my taxes for this year, it's going to be a big write-off. I think it'll write off perhaps more than my taxable income, perhaps from that oil drilling. When I get my monthly oil drilling revenue, that's income. It's a 15% write-off, so I'm taxed on 85% of what I get. And I'm not sure how I'm taxed on that yet. I'm not sure if I'll be taxed capital gains tax or is it just normal like income. I'm not sure on that, but I think there with oil drilling, just like real estate, there are tax benefits associated with it. So once my taxes are done for 2021, I will see exactly what is done because I do have a CPA. His name's Evan. I'll forget his last name. I won't say his last. I'm gonna get him. He's gonna come on my channel one day when I upgrade my equipment. He's gonna come on my channel. So both oil drilling and mineral rights acreage is a 15% write-off on the income. Mineral rights acreage is not. I do not get that big tax write-off like I do with the oil drilling. Okay, so, but it is out of the income I get. It's 15% write-off. Oil drilling and real estate is where it's at. If you need to save on your taxes, you buy rental property. It's kind of like a tax shelter, kind of like that, but you can save, you can reduce your taxes by a lot. If you invest in oil drilling, say if you're wealthy, you're very wealthy, and you put in $500,000 and you're a top dog at a company, you're making $1 million plus a year in your salary, and you plop down $500,000 in oil drilling and you write off roughly 80 to 85% of that, that could really reduce your tax burden by a lot, just a lot, okay? Taxes are one of the biggest expenses of any business owner. Doesn't matter if you're a business owner like my tenant who's buying my triplex is a business owner. Taxes are one of the biggest expenses. If you're a W-2 worker, look at your paycheck. Look at the amount of tax you pay. You pay a lot in tax, all right? If real estate can increase your income and decrease your taxes, that's win-win. If you can get into oil drilling and decrease your taxes even further, that's win-win, okay? So when I get my CPA on here, that'll probably be next year. I may get him on sooner rather than later just to give an overview of, he knows, he's a CPA. He knows more than I do. Give an overview of taxes, and maybe we'll get him on later in the year once my 2021 taxes are done, and we can talk more in depth about what he could do for my taxes. Okay? All right, good enough. All right, my hair is finally drying from getting it washed. I need to kind of comb it out a little bit. I need to finish my cup of green tea, and life will go on. All right, keep smiling, keep loving life. Mazske is signing out.